I wasn't going to make this video. I'm literally about to walk out the door, jacket on, phone in my pocket. Then I see JP Morgan's updated gold forecast cross my feed. $6,300 per ounce. And I stopped. Because that's not some fringe newsletter. That's not some conspiracy blog. That's JP Morgan. The same bank that's been telling retail investors for years that gold is a relic, that crypto is the future, that you should be in equities. And now they're quietly telling their institutional clients, their private wealth management arm, their big money accounts, that gold is going to $6,300 by the end of 2026. And almost nobody is talking about it. So here I am recording this because someone needs to explain what's actually happening here. I'm recording this right now from New York, and I want you to comment what day and date you're watching from because this story moves fast and I want the timeline to be crystal clear. And real quick, if you value this kind of no-drama, straight-shooting breakdown where we actually read what the banks are saying instead of what they're telling you to do me a favor, subscribe and comment FinTalk OG so the algorithm knows you want more of this. Now, in case you haven't seen what I'm talking about, here's the claim making the rounds. Gold just punched through $5,000. JP Morgan revised their target to $6,300. Goldman Sachs is at $4,900. Deutsche Bank says $6,000 plus. Mo's bull case is around $6,500. UBS says $6,200, and on the surface it sounds clean. Big banks, big numbers, gold goes up. But when you slow it down piece by piece, you realize this isn't just about price targets. This is about a massive contradiction that's been hiding in plain sight for years. The same institutions that have been publicly dismissive of gold, calling it a barbarous relic, telling you it doesn't generate cash flow, that it's not productive, those same banks have been accumulating it, recommending it to their private clients, and now they're putting out price targets that would make gold one of the best performing assets of the decade. That's clean. It's also exactly the kind of thing that should make you ask, what do they know that they're not saying on CNBC? So I'm going to break down three things. First, what these banks are actually saying in their reports, not the headlines, the actual language. Second, why there's such a massive gap between what Wall Street says publicly and what they're doing privately. And third, what this means for you if you own gold, if you're thinking about buying gold, or if you're sitting on the sidelines wondering if you missed it. So let's start with what we can verify. JP Morgan's commodities team, not some random analyst, their commodities research division, put out an updated forecast. $6,300 per ounce by the end of 2026. That's not a typo. That's not a bull case scenario tucked into the footnotes. That's their base case. Now, they didn't just pull that number out of thin air. They're citing a few things. Central bank demand, which has been running at record levels for over 2 years. Geopolitical instability, which is a polite way of saying the world is more fractured than it's been in decades. Currency debasement, which is a polite way of saying every major central bank is still printing money even though they say they're not. And supply constraints, which is a polite way of saying there's not enough new gold coming out of the ground to meet the demand that's building. Those are the mechanisms they're pointing to. Not hype, not Reddit threads, structural factors that don't reverse quickly. Now Goldman Sachs, they're at 4,900. Why lower? Because they're more conservative on the timeline. They think it takes longer for central banks to fully rotate out of dollars and into gold. They think the Fed might tighten more than the market expects, which would strengthen the dollar temporarily and put a lid on gold in the short term. But even Goldman, the most institutionally cautious of the big banks, is saying gold goes up another 20% from here. That's not a hedge. That's a position. Deutsche Bank says 6,000 plus. They're not giving you a precise number because they're modeling multiple scenarios, but their base case assumes continued dollar weakness, continued fiscal expansion in the U.S., and continued accumulation by non-Western central banks. And here's the phrase they use in the report, and I'm paraphrasing, but this is close. Gold is remonetizing in real time. That's not some gold bug talking. That's Deutsche Bank saying the thing that conspiracy theorists have been saying for a decade, except now it's in a PDF with a Deutsche Bank logo on it. Mo, Bank of Montreal, their bull case is around 6,500. Bull case meaning if things go the way they think they might, not worst case, not moonshot, just the upper end of plausible. And UBS, 6,200. So you've got a cluster. You've got JPMorgan at 63, Deutsche at 6,000, UBS at 62, BMO at 65, Goldman at 49. The range is 4,900 to 6,500, depending on who you ask and what assumptions they're using. But here's what matters. Every single one of them is saying gold is going significantly higher from here. Not maybe, not if. They're saying it's going higher, and they're telling their clients to position accordingly. Now here's where it gets interesting. If you go back and look at what these same banks were saying 5 years ago, the tone was completely different. Gold was a defensive play. Gold was something you held if you were scared. Gold didn't belong in a growth portfolio. Fast forward to right now as I'm recording this, and the language has flipped. Now it's a strategic allocation. Now it's a currency hedge. Now it's a geopolitical risk offset. Same asset, different story. So what changed? Did gold suddenly become productive? Did it start generating cash flow? No. What changed is that the world these banks are modeling, the world their economists and strategists are looking at, that world now includes things that make gold not just useful, but necessary. And they know it. They've known it. They just weren't saying it loudly until recently. Here's a question for you. If JPMorgan is telling their wealth management clients that gold is going to 6,300 and you're not a wealth management client, do you think they're going to put that on the front page of their public-facing research? Or do you think that stays in the private briefings, the PDFs that get emailed to people with 8-figure accounts? Drop that in the comments because I read them and I want to know if you've seen this kind of thing before. Now let's talk about the contradiction, because this is where it gets uncomfortable. For years, and I mean years, the mainstream narrative around gold has been dismissive. You hear it on financial television. You hear it from talking heads. Gold doesn't pay a dividend. Gold doesn't grow earnings. Gold just sits there. It's a pet rock. And while that narrative was being pushed publicly, quietly, central banks were buying. Quietly, the same institutions telling you to stay in equities were adding gold to their balance sheets. Quietly, the smart money, the old money, the money that moves slow and thinks long term, that money was rotating into physical metal. And now, right now as we speak, you're seeing the banks that push the pet rock narrative put out price targets that would make gold one of the best risk-adjusted returns of the decade. That's not a mistake. That's not a coincidence. That's a strategy. Here's the clean way to think about it. When a bank tells retail investors that an asset is old-fashioned or unproductive, and at the same time tells institutional clients that the same asset is a strategic hold with significant upside, that's not analysis. That's positioning. They want to accumulate before the crowd arrives. And the way you keep the crowd out is you tell them the asset is boring, or risky, or outdated, or whatever story keeps them in the assets you want them in so that you can move into the assets you actually want. This is not a conspiracy theory. This is how large institutions operate. They don't broadcast their moves. They make their moves, then they broadcast, and by the time you hear about it on CNBC, they're already positioned. So why are they saying it now? Why are these targets coming out in the open? Because they're done accumulating. Or close to it. Because the move is far enough along that they need their clients, their big clients, to understand what's happening so those clients don't panic or miss the next leg. And because the macro setup is now so obvious that staying quiet about it makes you look incompetent. If you're a strategist at a major bank and you didn't see this coming, and gold rips another 50%, your clients are going to ask why you didn't tell them. So now they're telling them. Not because they suddenly became transparent, because the trade is on and they need their people positioned correctly. Now, before we get into what you actually do with this information, I need to say one thing clearly. A price target is not a guarantee. It's a model. It's someone's best guess based on assumptions that could be wrong. JPMorgan could be wrong, Goldman could be wrong, all of them could be wrong. Markets don't move in straight lines. Gold could hit 60,300. It could also pull back to 45, consolidate for 6 months, then rip to 70. Or it could stall at 52 and chop for a year. I don't know. They don't know. What we do know is that the institutions with the most resources, the most data, and the most access are saying the macro setup supports significantly higher prices. And they're saying it loudly enough that it's in their public research now. That's the signal, not the exact number. The fact that they're willing to put the number out there. Now let's map two plausible paths without pretending we can predict the exact candle. Path 1. Gold consolidates here, mid-5,000s, for a few months. The dollar strengthens temporarily because the Fed talks tough. Equities stay strong. Gold looks boring. Retail loses interest. Then, sometime in the back half of the year, something breaks. Could be a sovereign debt issue. Could be a currency crisis in a mid-sized economy. Could be a geopolitical flashpoint that spooks the bond market. And gold rips. 6,300 by year-end, just like JPMorgan said. That's plausible. That's within the set of things this market is capable of doing. Path 2. Gold doesn't consolidate. It just keeps grinding higher. 55, 58, 61, 64. Steady bid. No fireworks. Central banks keep buying. Institutions keep rotating in. Retail finally starts paying attention around 6,000, which is when the FOMO kicks in, and that's when you get the parabolic move. 63 by end of year turns into 70 by early 2027. That's also plausible. Both of these worlds can be true in different timelines. I'm not predicting one over the other. I'm saying both fit the structure we're seeing. Here's what to watch. First, central bank buying data. If that slows, if you see months where central banks are net sellers or flat, that changes the story. Right now they're buying. If that continues, the bid under gold stays strong. Second, the dollar index. If the dollar rips higher and stays elevated, that's going to put pressure on gold in dollar terms, at least temporarily. If the dollar weakens or even just stays flat, gold has room to run. Third, real yields. If real yields, that's nominal yields minus inflation, if those go deeply positive, that's historically been a headwind for gold. If they stay low or go negative, that's rocket fuel. And fourth, watch what the banks do, not what they say. If you start seeing headlines that institutions are reducing gold exposure, that's a tell. If you see them adding, that confirms the trade. Now here's the uncomfortable part. If you're not already in gold, or if you've been waiting for a pullback, you might not get the pullback you want. You might get a shallow dip that doesn't feel like enough of a discount, and then it rips again and you're sitting there watching. That's the risk of waiting. The other risk, the one nobody wants to talk about, is that you buy at 52, It goes to 47 and you panic out right before it goes to 65. That's the scenario that crushes people, not the price going down. The price going down and you not being prepared for it emotionally, so you sell at the worst possible time. And this is why position sizing matters. This is why having a plan matters. This is why you don't just chase a headline. So, what do you actually do with this information? Here's a simple action plan. No drama. Step 1. Decide your maximum allocation first. Write it down. If you're losing sleep over your gold position, you're too big. If you don't own any and you're watching these targets, ask yourself, if gold hits 6,500 and I have zero exposure, how am I going to feel? That's your signal to size in, not with everything, but with something. Step 2. If you're already in and you're up a lot, consider trimming some. Not all, some. If your position doubled, take half off. Lock in the original bet. Let the rest run. That way, if it pulls back, you don't feel stupid. If it rips higher, you're still in the game. Step 3. Don't use leverage. Gold doesn't need leverage to be exciting. It will provide the excitement for free. If you're in futures, if you're in leveraged ETFs, understand that those products can liquidate you on a normal pullback even if the long-term thesis is correct. Step 4. The best time to buy isn't always when you're most excited. The best time to buy is when you can still breathe. If you're reading these price targets and your heart is racing, that's probably not the moment to go all in. That's the moment to take a breath. Write down your plan and execute it slowly. Now, here are my questions for you. Do you think JPMorgan is putting out these targets because they genuinely believe it, or because they're already positioned and they need the crowd to come in and push it higher? And if you own gold right now, are you holding it as insurance, or are you holding it for upside? Drop your answer below, and remember to include what day and date you're watching from. If you got value out of this, subscribe and comment FinTalk OG so I know you want to follow up when these banks update their targets again, because they will. And if this helped you, share it with someone who's staring at charts trying to figure out if they missed the move. All right, stay sharp, and I'll talk to you soon. And just so we're crystal clear, this is educational content. It's my take based on publicly discussed information and my own reasoning, and it's not personal financial advice. I'm not your advisor. I don't know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation, and if you need personal advice, get it from a qualified professional who knows your situation.